Hey, welcome to the podcast, everybody, Through a Trader's Eyes. Thank you for joining me. Appreciate it. Well, the stock market rip-roared higher today. The Dow Jones finished at 15,460, up 170 points. 170 points ain't what it used to be, 1.1%. Still a very good day, but it's interesting that 170 points isn't that big anymore because it's percentage terms, right? 15,000 is a lot higher than when the Dow was at 10,000. But still a good day. The S&P was a little stronger at 1.3%, 6% up 22 points at 1675. The NASDAQ was up 1.6%, the strongest, up 57 points. And the Russell and mid-cap indices were kind of like the S&P, kind of in the middle of the road. Interest rates were down today. Treasury yields dropped all the way down to 2.57%. So they're certainly not in a downtrend, but they're going the direction that bond bulls would like. And I guess people that borrow, lenders want to see it keep going up. Borrowers want to see it head back down. The VIX really didn't fall that much. Was at 14. It's been going down. And if you notice here, something that a lot of people are noticing about the markets is, every time we've had these fear spikes, that has been the time to buy. And that will continue as long as we're in this bull market. And I think it will continue. The thing that you look for in a bear market, of course, is you sell when people get complacent. And I think the problem that people have in this market is selling when there's complacency, which there is right now. That doesn't necessarily mean that you sell. And I think, now if we get down to a level maybe way down here, then maybe you do sell for a short-term pullback. But really, that's a smaller trade. The bigger trade is buying the fear. And I think what's happening right now, and this is something that has a lot of people kind of baffled. I put out on Twitter today, and by the way, if you want to follow me on Twitter, it's at Karl Eggers, KarlEggerss. But I put out on Twitter that it's as if Ben Bernanke, who spoke yesterday, had spoke at a conference and then gave a kind of some statements afterwards, and wasn't a Q&A, but basically gave some off-the-cuff comments. Markets jumped on that, what he said, and I'll get to that in a minute. But it's as if Ben Bernanke is speaking a language which nobody on the planet has ever heard of before, and yet everybody's trying to translate what he's saying, right? He's talking out of both sides of his mouth, and it's terribly confusing. Now, usually the markets do very poorly when there's confusion and uncertainty, and yet the market's doing very well right now. Why is that? Well, a couple of reasons. Number one, and by the way, this is uncertainty in here, right? We had about a 6% sell-off, and we've had a rally back to the old highs. But why is the market rallying based on what Ben Bernanke said yesterday? Well, I think what's happening is I don't think there's any question that the Fed wanted to. Again, you can discuss why they mentioned tapering. Are they really going to do it? Why are they doing it right now? There's a whole debate around that. I think it's been a couple of things. Number one, we've talked about in the past on prior podcasts that Ben Bernanke is going to leave, and I think he wants to tie this thing up in a bow and say, hey, I didn't completely stop the purchases, but I started the tapering, and I started winding this thing down. I started it, and I'm going to complete it. The second part of that is the Fed is worried about a bubble. Now, you may be laughing because this bond bubble they've created has been there for years, but they want to prevent a further bubble. So if they don't start tapering now, they could run into some major issues down the road. So they have to mention it and maybe start the process. I don't know if the Fed really anticipated, though, that this move from 1.6% in May to 2.6% on 10-year treasuries that quickly. This is one of the biggest and baddest and nastiest jumps in interest rates we've seen ever. And you may be thinking back to 1994 when it went from 5 to 8% and go, well, that's bigger. But the change, the rate of change that it's gone up. Remember, a move from 1.6 to 2.6 is a bigger percentage move than maybe 5 to 8 or something like that. So you have to look at the percentages of these and also how fast it's going up. It's not the percentage necessarily, but how fast it's rising. Remember, this happened in short order. This happened in 2 months that this happened. And so I personally don't think the economy has had a chance to settle in and figure out how it's going to do with higher interest rates. So you saw a surge in some housing because people that were on the fence that were waiting to lock in, why would you lock in your interest rate when it's doing this? But as soon as it turns the corner, you lock it in. And so I think you saw a surge in these home sales last month. Let's see in the next couple of months what's happens to that. We also have, of course, oil rising, which I mentioned in yesterday's podcast, and that's been at this old high that we haven't seen since January of 12. And we'll talk about oil and maybe how to play that for a trade potentially. But that is at $107 a barrel. So and it pulled back a little bit today, pulled back a couple percent. This isn't updated as of yet on this, but so that's good. But the thing is, the dollar strengthening has been good. That's what we want. And the economy has been doing maybe better than people thought it would. But what happened today was the dollar actually went down quite a bit, about 1.6%. Okay? So what's happening is, I think with interest rates rising as fast as they did, I think it has scared the Fed that they announced that they may taper, and all of a sudden the market did everything for them. And now they're kind of backpedaling. We saw that right after Ben Bernanke's press conference a while back. Some of the Fed governors coming out and basically, kind of backpedaling. And now we've heard Bernanke kind of back and forth say, yeah, we're going to taper. But listen, we're going to keep short-term rates very, very low for a long time. And long-term rates, we're going to taper. But listen, don't confuse me. That's not taking the punch bowl away. That's letting my foot off the accelerator by a quarter of an inch, okay? Maybe I take it from $85 billion to $75 billion a month. I'm still adding a lot of money to the economy, and that gave people comfort that the Fed's not going anywhere. I honestly don't think anything has really changed. I think basically interest rates going up and oil going up is going to put a little drag on the economy. You saw the initial jobless claims this morning worse than expected, meaning more people filing for unemployment. So this is an economy that is going to remain mediocre. And as long as it doesn't fall apart, that's going to be good for stocks. And I also think it's going to be good for bonds. I think bonds are still a good place right now. And especially after this run that they've had on the downside, I think there's a lot of opportunities. You saw big moves today in all types of bonds across the board. Municipal bonds, mortgage REITs, regular REITs. You saw all of those things. But what happened, what's a little different now, is that with the dollar weakening, guess what finally turned the corner? Gold. Gold actually had a almost 3% up day today. And so look for gold, look for GLD now to possibly come up and fill this little gap here and get back up to $130 and then again potentially roll over at that point. So watch the 50-day moving average for gold. But a lot of people don't like this because they're saying, look, this is more Fed-induced rally. This rally today is more Fed-induced than what we've seen in the past because, with the dollar going up, that shows strength in the economy. The dollar going down today shows stimulus. That's what that shows. Now, from a stock market perspective, the stock market has liked both. The stock market has been doing very well, and it's done pretty well with the dollar going up. But I think the economy is going to remain lethargic, which is going to put a cap on interest rates, and I think the stock market could still do very well. When the stock market won't do well, I think is if this data gets really weak and the economy falls apart. Now, so that's my take on what's going on right now and why the markets are doing what they're doing. But I think in the short run, if you see what's going on with the S&P, and it was a strong day today when you look at the internals, no question about it. But when you look at this, we now have to draw a new line, right? And this new line is the elephant in the room, which is this double top, okay? So we now have the market back inside the little trend that we had talked about yesterday, back in this uptrend, but now we have this double top everybody's looking at. But here's the thing. I want to point you out to one of the negative divergences that I'm seeing. This is a RSI, it's a technical thing, a relative strength index, and you can see it made a high here, and it's lower now than it was back then, and yet the market is at the same spot, if not higher, on a closing basis than it's ever been. Okay, that's a negative divergence. So watch that because that's something that I think is interesting. The other thing is some of these short-term indicators we watch are at very extreme, some of the most extremes we've seen in 2 or 3 years. So on a very short-term basis, the market is way overextended, way overextended. So I think the timing of this matters. Now you may say, well, and I am still bullish on stocks in the longer term here. Again, assuming the economy doesn't fall apart, which I don't think it will, but I think it could show some headwinds coming up with interest rates going up and gasoline, as we talked about it. But if you're wanting to buy stocks, do you do it at this level? I think there's 2 scenarios. One, if it breaks out, comes back to the old breakout here, that would be a buy spot. But the other thing that I think is more likely is that we get a brief break above. And we come back into this, and perhaps we come back down to one of these moving averages, maybe even this one. And so it's not as low as we got back here, but we're somewhere around 1,600, and then it takes off again. So if you're somebody that says, well, I don't really care about a 5, even a 10% correction, then you can probably go ahead and buy now. But I think buying the dips makes more sense right here because the market's so extended to the upside. Now we have seen a big burst of breadth, meaning there's been a big spreading out of money. Money's being dispersed into all sectors right now, and that's actually very healthy. And I think it's very healthy when you look at longer term what's going to happen to the market. But in the very short term, you've got a double top. You've got this rally today was purely based on the Fed. And for people who say the market's not addicted to the Fed, yes, it is. Purely addicted, and it was purely based on that. This had nothing to do with economic data at all. This had all to do with the Fed saying, hey, easy, we weren't completely serious. You didn't believe us when we said we were going to taper. But remember, they could have tapered from $85 billion a month in bonds to $50 billion. Well, what if they say they're going to go to $80 billion? Then they've changed what they were going to do, but still being able to say, we told you we're going to taper, and we are. So watch all of that. The other thing that's being tossed around is, what if the Fed, they want to buy $1 trillion of bonds, right? And they're going to start tapering, doing less each month. Why not just buy the $1 trillion over the next 4 months? Why not throw a bunch of it at the market right now and then be done sooner than later? Why not buy $250 billion in bonds, get the interest rates way down, and then say, okay, we're done? So, who knows what the Fed's going to do? But the fact that they say they may taper and they could do it in September, maybe they will, but the amount may be changing. So who knows? The Fed I don't even know if the Fed knows what they're doing. They're basically saying a comment one day and then they undo it the next day, and the market's trying to figure it out, and so it's been choppy. But obviously the bond market and the stock market liked what Uncle Ben said today. But in the short term, again, watch this, because I think ultimately you may get a better entry point than buying at 1675, which is where it is right now on the S&P. So watch to see if it pulls back. A nice test would be somewhere down here, maybe 1600, because of this moving average. It'd be a little higher than this point right here. And so this would be a nice key spot for it to pull back to. And that's not that far. You're talking 75 points, which is about 5%. That would be a nice pullback. It would be a little less than the pullback we saw here. So that would be good, and then we could go off to the races. But I don't know you have to ask yourself, when you look at this market here, if you're going to buy everything today, is the market going to continue on this trajectory like this? Is this the buy spot? And again, is that scenario possible? It's possible we get a few more days and it pulls back and it holds. And if it holds at that level, fantastic. But I think as stretched as things are, it could come back in first. But again, look at some of these things that are out of favor right now. Things like in the bond area and some gold mining stocks and some things that are related to interest rates. Those are the things that went up the most today. Because after all, the stock market it did only go up about 1% today on the Dow Jones. Now let's take a look at something. I got a question today from somebody asking, hey, I want to potentially short oil. How do I do that? And I don't think that's necessarily a bad play, because if you look at oil, we know that we're, again, at these, and this isn't updated through today, so it did pull back a little bit, but we're at these early 2012 prices. What's the best way to do that? There is an exchange-traded fund, SCO. It's a it's a short oil ETF, and that may be the best way to do that. But if you want to bounce, if you think oil's coming back down now, and you look at SCO here, now this is an ultra short, so you got to be careful with these. But if you go back and look, March of 2012 was the low in this. So, you could see a bounce, and I'm going to show you something that why these things do have potential. I'm not saying I'm necessarily on board with this. I think it's interesting watching the dollar, how it's been going up, and yet oil's been going up as well. But, watch for this to at least bounce to somewhere right in here. And that would be $35, $36. So that's an interesting one. But again, these are ones that you want to hold shorter term, make your money and move on and then reset. Don't expect that this is going to go on for 3 years and you can just hold this, because it has that deterioration in the correlation, as we always talk about. If you look at something like Nugget, this is the gold miners, okay? It's 3 times the gold miners. So this thing was up 22% today. So there's ways, some of these leverage do work if you want some quick money. And there's a couple ways to play them. You either use less money and buy these, or you buy all the money you want in it and get triple the leverage, and you get these extreme moves. But again, these things they move a lot. This thing could be down 10, 12% tomorrow. So watch these, but I think what's likely to happen, let's just go to the regular gold mining stocks. And I'll take this little box off here. We obviously broke out of that. But I think that's the place where we could come back to. If you look at this is the logical place. You've got the 50-day moving average coming into play, and right in here, and on top of that, you've got this is the old breakdown. So that may mean another day 2, 3 of what we're kind of going through right now, and maybe not that much. GDX, this was up 7% today. But if it had 3 more days of 2% or something like that, it could come up to here and then fall back down again. So watch gold, because we've seen one-day reversals in some of this stuff. We haven't seen trends. And what I would prefer to see, if you're somebody that, and I know people that own lots of gold and gold miners and have ridden this all the way down, as far as a big percentage of their portfolio. I own as I've mentioned in the past, full disclosure, I own a little piece of GLD for one strategy that I manage, and I think it's 3% of that. So most of the money I oversee may have less than 1% in gold, in GLD. But I know people that have significant amounts of gold. And if you're somebody that's wanting to see the thing turn, what you have to see first is you have to see the trend change. If you look at GDX here, and this, it doesn't take a rocket scientist to figure this out, that this thing is going like this. So we need it to turn like this, right? And more than likely, it's going to turn like this with a V bottom, and then it may pull back and test it, and then that's your chance. So this is just mean reversion. And for those that don't know what that is, that means this thing's just getting back. It got outside of its comfort zone, and then it came back to the 50-day moving average, and now it may come back here and then fall until we start seeing lower highs like this. The thing hasn't bottomed. Okay, I think an example of that would be Apple. If you look at Apple here, this is in the bottoming process. How do I know this? Well, I don't know it, but I can tell you if you look at things like let's call it the 20-day moving average, which is this green line, you can see that Apple was going straight down, right? And now this line's moving sideways. How about the 50-day moving average? It was going down. It's now moving sideways. Even the 100 days starting to move sideways. That's what a bottoming process looks like. And Apple could still fall further, but the point of the story is that these things, when they're going straight down like this, they don't typically V-bottom and go straight up. There are stocks that will do that, but that's over more of a short-term time frame. For example, right here, where Apple first fell, and then it rallied from, what was this? The low was about $500, and it rallied all the way up to $600. That was a big V-bottom, but it didn't last. So for a long-lasting turnaround, you have to see this thing go down, move sideways, and then turn back up again, and that's where the moving averages come into play. Let's see, what else do we have today? That's really about it. I think overall, again, the market in the very, very short term is very extended. You can question today's rally from a fundamental standpoint, but while you want to debate that with somebody, the idea is to try to make money. And today, pretty much everything was green, and so that's good. But I think in the very short term, this market's extended, and we would expect a pullback. And again, let's watch the quality of the pullback, so to speak. If it's a weak pullback, has no volume, not a lot of things are being dumped in distribution, then you could see this thing move much higher. But ultimately, I think in the next several months, this thing will be higher. It's just a matter of timing. When do you get in? When do you take profits on things? And overall, I think if the market continues the way it is, spreading out is better, right? Because everything went up today. There wasn't very much that was down today, and so spreading out made more sense than owning some individual securities. All right, so thanks for the questions. Appreciate it. CarlEggers.com is the blog. EggersCapital.com is the money management website. We're on Facebook, Twitter, Google+, iTunes, all of that. So thank you very much. Have a wonderful evening.